Hello friends, today we are going to discuss the mutual funds concept of a trailing return. So what do you mean by trailing returns? Whenever we are evaluating the mutual funds, there are different parameters considered when doing this evaluation. Some of these parameters like what are my returns over a given point of over a period. The other parameter is what is expense ratio. Higher expense ratio means the returns would be poor. The assets under management, the size of it is also one more parameter. And of course, the risk the mutual fund manager is taking with a given portfolio while generating this return. While these different parameters are typically analyzed while evaluating mutual funds, the most important parameter as far as the investor is concerned is about the returns or the performance of the mutual fund. So the question is, how do you analyze the return of the mutual fund? Actually, there are different ways in which the returns can be analyzed. So the most simplest thing is the analysis of the return across two different points. So let's assume today is at 30th of October 2020. So the return the mutual fund has generated from 30th of October 2019 to 30th of October 2020. So that's 1 year return is a simplest way to calculate the return. Compare the different funds against this 1 year return and then take a decision. The period can be different. So at some point of time, we would like to evaluate 1 year performance. Sometimes it is 3 year performance. Sometimes it is even longer term, say 5 year, 10 year, or even say 15 year performance also. At the same time, there are mutual funds where they could be analyzed for the short-term returns over say 1 week, 1 month, or even say 3 or 6 months as well. Typically, when the trailing return is taken for the longer duration, that is more than 1 year, the returns are interpreted as CAGR, that is compounded annual return is what is calculated. But this trailing return is generally between the 2 points and it could be across different horizons. The other way to see the performance of the mutual fund is through the SIP returns. So in this case, the investor is making the investments on monthly basis, and the IRR, that's the internal rate of return of these investments, is calculated, and that gives us the SIP return. The third, and I think it is gaining a little prominence, is called as rolling return. So what do you mean by rolling return? So let's take example of starting the evaluation period from 1st of January 2020, and we would like to see the rolling return for 1 year. So what we'll do is the return between 1st of January 2019 to 1st of January 2020, that is 1 year return of that particular day is calculated. Now, next data point is the next day, that is 2nd of January 2020. For this, the comparison is against 2nd of January 2019. So each day is plotted, and what you get is the different return, that's a different 1 year return for each day, and then calculate the average return of this particular period. Now what you will see is this rolling return, you are calculating it for every day. It's not just between 2 points. So let us try to see the implications of this. For the sake of discussion, we'll compare the trailing return and the rolling returns. SIP returns are unique, but we'll try to compare the performance of the fund based upon these two key parameters, that is trailing return and rolling return. In case of trailing return, the start and the end time plays a huge role in terms of the return that is generated, and the comparisons might not be consistent. So for example, if there is a recent outperformance of this fund, then you will see the higher return. And similarly, if you start with the very high starting point for the mutual fund, then the comparison might not give the higher return. Compare that to the rolling return. Here we are comparing the return of each and every day. So the performance is measured across the entire time period, and the measurements are they factor in the consistency significantly. Let's take an example how the two different returns present a picture. And for the sake of discussion, I have taken the small cap fund, and in that I have just taken the two funds. One is a Axis small cap fund and the other one is SBI small cap fund. Both of them are rated very highly on Value Research Online. Axis has a rating of 4 stars and the SBI has a rating of 5 stars. If you see the 1 year return, the Axis has given 6.8% return while SBI has given 9.7% return. Whereas for the 3 year return, the Axis has slightly better performance compared to the SBI's performance over 3 year period. Based upon this, which fund will you choose? So it looks like the SBI is a winner. Value Research has given the higher rating for it, and 1 year performance is much better. The recent performance is better compared to Axis small cap fund. Now, this is how the trailing returns is giving us the indication that SBI is a good performer. Compare that with the rolling return. So if you see from this graph, the yellow line is for the Axis small cap fund, the blue line is for the SBI small cap fund, and the green line is for the category average for the entire small cap space. If you see both of the funds, both Axis as well as SBI has beaten the category average significantly, and that's the reason why they are given the higher rating by the Value Research also 4 and 5 respectively. But if you see the daily return, that's a rolling return, one can see that Axis has consistently given the higher return compared to even SBI, and it has beaten the category average significantly. But as you come to July, you can see that the SBI has overtaken the returns of Axis, and as we are in the month of October, the results are tapering off. So the outperformance of both the funds is kind of diminishing and is getting very close to the return of the category average. One more thing you can note is the tabular representation of the same data, that is average, median, returns, as well as how many times the returns have been less than 0%, 0 to 8%, 8 to 12, and different buckets. Visually also it is representing the different colors, and Axis has shown the outperformance. So based upon this, the one can take a call that Axis is much better compared to SBI. Whereas in the earlier analysis, based upon the trailing returns, we had thought that SBI has better performance. Now is a case for multi-cap. So how do you rate the different mutual funds from the multi-cap segment? If you see the initial before the significant fall in the stock market, the difference between the different mutual fund performance was not significant. But as the markets have recovered, there are two funds which have outperformed the other two, and these are Parag Parikh and the UTI equity fund. So the rolling returns of the mutual fund give a different perspective, and these should be taken into consideration while taking investment call. Thank you.